Yes, good evening, everybody. And we'll continue our discussion on working capital management. In the last class, we introduced what working capital is all about. And we said working capital can be defined as the capital available for conducting day-to-day operations of a business. Though we define working capital in diverse ways. So we went further to say it is the excess of current assets over current liabilities, and it is also described as a financial will of a business because it indicates the ability of a business to go through bad financial storm. So working capital, what it does is that it emphasizes the liquidity objective of a business, and other objective should also be pursued. That is, if it is in tandem or consistent with the liquidity objective. So it is very important to maintain adequate working capital for both short-term and long-term survival of a business, because sufficient liquidity must be maintained in order to make profit likewise, in order for profitability to be achieved. Because sometimes some company can make profits and don't have sufficient liquidity for survival. So I can say that liquidity must be maintained because the most profitable company may find itself in trouble water if it does not have adequate cash flow to meet its liabilities as it falls due. So we introduced this last week and talking about working capital. Now, there is a need for us to understand the management of working capital, which we also talked about last week, the management of working capital. So we said working capital management ensures that sufficient liquid resources are maintained, and it involves striking balance between the requirements to minimize the risk of insolvency and the requirements to maximize the return on assets. So through this, the risk of insolvency, or through this, I will say that sometimes there is a need to maintain high level of cash holding that will affect profitability, because resources tied up in cash can be reinvested in a business or in an investment that will yield profitability. So a clear policy must be in place in every organization for management of each component of working capital. The component of working capital entails stock, cash. It entails receivables, that is debtors. And on the other hand, in terms of current liability, we have trade payables. That is why we'll be looking at each of these components. So what is the objective of working capital management? The objective of working capital management, we said the two main objectives of working capital management are: it's to ensure that organization has sufficient liquid resources to continue in business, and also to increase profitability. So we talked about some of these in our last class, but there are some ratios I didn't mention, which I expect us to know. Ratios like current ratio, current ratio, current ratio. The formula for current ratio is what? is current assets divided by what? Current liability. And still we have quick ratio or acid test ratio. The formula is what? Current assets less inventories divided by current liabilities. We have our current acid test ratio or quick ratio. So also in that class, I asked question on what is over trading and overcapitalization and undercapitalization. I'm so concerned about these words because they can ask us in the exams. So we must understand what overcapitalization is all about. We must understand what undercapitalization is all about. When we talk about overcapitalization, what are we referring to? When we talk about overcapitalization, what are we referring to? Anybody to help? Overcapitalization. Yes, let's just assume you just seen this in your exams. Explain this in the light of this organization. Explain this. Overcapitalization. From the word, they are compound words, two words joined together.
Okay.
Yes.
It's when a business does not have sufficient fund or sufficient capital to run
Okay.
the business.
Okay. 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 All right. Anybody else want to try?
And because of this, if it does not have business to run its sorry, if it does not have enough finance or capital to run the business, maybe you definitely they will collect goods on credit, then paying back will be an issue. So in this situation, it will affect the business in the long run.
Okay. Okay. That is fine.
Okay, can I say something?
Yes, 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 you can.
Yeah, this is when a company raise more capital, maybe through debt or equity, more than what they actually need.
Okay. Yes. Yes. That is overcapitalization. In case you don't have it in your book, write it. Write it as I say it now. Yes. Write it. Most of the things I will say most times might not be in my slide. So you have your book, please, to write. Or if you don't write, maybe when you watch the video again, you
Mm.
can take down your notes. Because by the time I start dictating note here, it will not go anywhere. Yes, but I will try and make sure most of the things I will say are so that you can have them all detailed. So when we talk about overcapitalization, this refers to this can also be referred to as under trading. Under trading, take note of that. This can also be referred to as under trading, and I'll say that these occur when there is excess working capital. Excess working capital, that is, you have excess stocks, you have excess uh, debtors, that is excess receivables, you have excess cash, and let's say few creditors. And this suggests that the company has invested heavily on current assets, which leads to lower return on investment and unnecessary tying up long-term fund, which could have opportunity cost elsewhere. So overcapitalization is having too much of working capital, too much when there is excess working capital. So with a good management, overcapitalization in relation to working capital should not exist. there should be a balance. Every organization should have a policy whereby you strike a balance whereby you don't tie too much money in your working capital. At least you should have sufficient amount of working capital, but not in excess that they are lying idle and they are not generating anything for the business. So I said with good management, overcapitalization in relation to working capital should not exist. And the warning signal of excessive working capital will be poor accounting ratio. That is poor accounting ratio. And the ratio that will assist in determining whether investment in working capital is okay or not can include sales stroke working capital ratio. Sales stroke working capital ratio. That is, the volume of sales will be shown as a ratio of working capital. That is, the volume of sales as a multiple of working capital investment. And another ratio that can show the relationship is liquidity ratio. That is current ratio. So a current ratio in excess of 2:1. 2:1. It shows that there is problem. The standard is of current ratio is 2:1. The standard of quick ratio is 1:1. That means at least you should have sufficient current assets to offset your current liability. That is 2 times of current assets should exist that can offset your current liability. While quick ratio is 1:1. 1:1, at least you should have immediate cash to offset your current liability. Also, you can have turnover periods or turnover period. Yes, that is, these are ratios that you can use to measure to see cases of overcapitalization. And what is undercapitalization? Undercapitalization. Undercapitalization. This is a situation where you are over trading. We talked about this last time. I asked a question in relation to this likewise. Where you are over trading. You have lean resources. Where you're trying to engage in business that is more than your you're trying to engage in business that is more than your capital. So undercapitalization refers to overtrading. That is a scenario where a firm tries to do too much. You try to do too much too quickly with too little long-term capital, trying to support too large a volume of trade with capital resources at its disposal. So that is, you are engaged in excessive trading with insufficient long-term resources. So these are some of the things we talked about in the last class, and we look at some of the ratios, and I gave a simple exercise for us to compute a working capital cycle period, which everybody performed well. So this evening, we're looking at inventory management as one of the aspects of working capital. Inventory. Now, when we talk about inventory, what do we refer to? Inventory. Talking about inventory management. Inventory management. That is how we manage our stocks. How we manage our stocks. And we have 3 forms of stocks. We have stock of raw material, stock of work in progress, stock of finished goods. So when we talk about inventory management on the slide, I put that this involves the method of ensuring that the right quality and quantity of the relevant stock is available at the right time and at the right place. Yes, there should be a policy in an organization whereby we don't run out of stock. By the time the stock level is at a point, there should be a signal that we should make an order. There should be a signal that we should make an order. So we shouldn't just fold our hands and wait until we are out of stock before we begin to place order. So there should be a policy based on the long-term objective or short-term objective of the organization on stock policy. So inventory is the raw materials, work in progress, and finished goods that are considered to be portion of a business asset that are ready and will be ready for sale. So inventory represents one of the most important assets of a business because the turnover of inventory represents one of the primary sources of revenue generation and subsequent earnings for the company's shareholders. So inventory is very key as part of the working capital of an organization. So the question now is, why do we hold inventory in an organization? I need somebody to speak to this. Why do we need to keep inventory? Though I've mentioned some of the points as I was trying to explain this, but still to make the class interactive, why do we hold inventory? Reasons for holding inventory.
To meet
We hold
regular
inventory.
demands.
One of the reasons of holding inventory is to avoid stock outs and also to meet customer demands.
Yes, very fine. Yes. So we hold inventory for quite a number of reasons. To meet regular demands, which I have here. Yes, to meet regular demands of customers, the reasons for holding inventory, for keeping inventory, and also to ensure smooth production run. In order not to have breakdown of production process, there is need for us to always hold the inventory in our warehouse so that once we need them, we can have access to them. And also, another reasons for holding inventory is to even out seasonal variation in demand, because there are certain time or period of the year that demand for your product will be high. So you need to make sure that you have sufficient stock to meet up with the abnormal demand at that period in time. Yes, when you have excessive demand beyond the normal, that is your peak period. So there is need for an organization to prepare towards that time, so that by the time you keep getting requests of orders and you're using your raw material, you will not be totally out of stock. And most times that raw material might be scarce during that your own peak period. So there is need for you to make adequate preparation to keep stock in your warehouse to meet up with your own peak period. So another reason for holding inventory is to take advantage of bulk purchase discounts. Sometimes when you buy in bulk, you will enjoy certain privilege, which is the discounts that will be given to you because you're buying in large quantity, which will in turn be a benefit in form of economies of large scale, because the cost per unit will be reduced when you buy in large quantity, and it will be result into cost savings for you as an organization. Another reason for holding inventory is to take benefit of unexpected scarcity in the product. Unexpected scarcity in the product, which I've earlier talked about, that scarcity can occur anytime. Economic situations that you don't plan for can result. Incidents of war can result. People sit down at home and you might not have access to certain raw materials, but once you have them in your warehouse, production will continue without any issues. So these are some of the reasons for holding inventory. These are some of the reasons for holding inventory. Now, another point we need to look at is, which is somehow closely related to what we've discussed now, reasons for holding inventory, is objectives of inventory control. objectives of inventory control. Why do we need to control our inventory? Why do we need to have inventory management in an organization? Sometimes I've worked in a manufacturing industry before, whereby we keep stocks of goods. One of the methods we use to issue out our stock is using the first in, first out approach, that is FIFO. When we receive goods from the manufacturing arm of the organization and we store in the warehouse, we arrange those products based on the SKU, yes, and in pallets. So we arrange them in that order. The store officer, even as we bill out on our own part as the account executive, we bill out customers or distributors request. The store person have to follow the inflow, that is the bin card is using in the store, to make sure that stock that have been in the store over time are issued out first. One of the advantage of doing that is that some of these goods have expiry dates. By the time you don't follow that sequence, some of the goods will become expired in the warehouse, and it will be to the loss of the organization, which is can be a punishable offense on the part of the store or warehouse manager. Yes, because you are expected to have a stock control policy whereby you issue out stock based on the expiry date. So as they comes in, you issue out, and not forget that you have certain stock in one corner in your warehouse. And the issue of stock count every week is also important, because as you take stock count, you observe each of these products and see which one is close to near to expiry, and make sure that they go out on time. So there is need for inventory control in organizations, whereby they keep stock of materials, stock of goods. Yes. Now, objective of inventory control, one, is to minimize risk of loss due to obsolescence or deterioration. Yes, because when you keep certain goods, they can become antique in your warehouse because of passage of time, and they will no longer be relevant or be in tandem with the trend. And if it has to do with raw material and with perishable goods, you have to make sure that you don't keep them too long. If not, they will get deteriorated, and the organization will tend to lose money, revenue in that form. So there is need for proper inventory control in organization. So another objective is to minimize capital investment in inventory by eliminating excessive stocks. Yes. So in regarding to this point, organization need to see how they strike a balance in investing their resources in capital investments, in order not to likewise keep too much stock in the organization. So inventory control is very key. It's very key to organizations, and for organizations to achieve this, they must set up a book, a record system, to ensure that this objective is achieved. By the time you just keep goods, stock goods in your warehouse without a proper means of control, they will tend to be lost. There is no how, especially when the warehouse is big and the stocks are much. Once you don't have a measure of control, there will always be issues relating to spoilage, deterioration, and the rest of it. So, and also, the objective of inventory control can help you to know when to restock and when you have to push out your stock as at when due. So by the time you don't have inventory control, you won't even know when your stocks are going down. or when a particular type of stock is going out, is going low in your warehouse, because you can have various forms of raw materials, material X, material Y, material Z, and your warehouse can be piled up with a particular one, and you are not mindful of the fact that this particular product or raw material is becoming stock out, is becoming too low in your warehouse, and you're assuming because material X and Y looks alike, or because you are not keeping accurate record as they come in and as they are being issued out. So where there is no systematic record of inventory, there might be issues. So the objective of inventory control is to ensure that there is a systematic way where we record inventory as we received in our warehouse and as we issue out to the manufacturing arm of the organization. And also, another objective is that to supply the required materials continuously. So where a material is required over and over again, in order for us to be consistent and not to have a break in the supply, there is need for inventory control. I put that the overall objective of inventory control is to maintain stock levels so that the total relevant cost of inventory are at minimum. So the overall objective is that we should have a reorder level. We should have an economic order quantity, whereby once our stock level is at this point, if our stock level is at 200 units, it shows that there is need for us to place an order to refill the warehouse. So it's to maintain stock levels so that total relevant cost of inventory at minimum. This relevant cost of inventory, what are the costs of inventory? When we talk about cost of inventory, what are the costs we incur in bringing in those inventory? One, we have ordering cost. Ordering cost. We can also have holding cost. Holding cost. These are some of the costs we incur to bring in inventory to the organization. So what we're trying to look at is that the point at which this cost will be at the minimum level, and still we can still meet up with our supply. That is the objective. So the economic order quantity will tell us more about that. That is EOQ. Now, inventory costs. We said these are costs associated with inventory management. That is, inventory costs include the following. One, ordering cost. If you're an accounting graduate here, can you indicate with an emoji? If you studied accounting in your first degree, HND, BSc, Victoria John, Ayo, Timmy Godfrey, the people are the accountants in the house. Okay. Most of these things, you should be familiar with them. Yes, I can see. You should be familiar with most of these things. Yes, I think in my 300 level, we did costs and management accounting. At that time, some of these things were not entering our head because the lecturers will just come to class 3 weeks to the exams, and we are pursuing a very good CGPA. We'll just be reading and without clear understanding. So those that did ATS too, ATS is also part of their discussion in ATS. Yes. So some people have started ICANN journey since where they were in university or their HND level. Yes. So ordering costs. When we talk about ordering costs, what are we referring to? Ordering costs. Don't worry, I will not ask question now. I'll be thinking about the next one. Let me start. Ordering costs. Ordering costs are costs incurred when placing an order up to the point of receiving the goods into the warehouse. Ordering. Ordering cost is the cost we incurred when we are requesting another organization to supply us. And at the point of moving the goods from the supplier to the warehouse, the whole cost we incur will be termed as what? Ordering costs. Will be termed as ordering costs. So what are the components of this ordering cost? What are those costs, those likely costs that make up ordering costs? Number one that make up this ordering cost, we can have cost of preparing purchase orders. The cost of preparing the purchase order is a makeup of ordering cost. When you prepare your purchase order, you have to send to company B. You are company A. Once you prepare it, you send. The cost you incur. The cost you incur in sending that or in paying the person that will make the dispatch, yes, to company B, is also ordering costs. That is costs of preparing the purchase order, administrative costs involved. Administrative costs involve the paperwork, communication, approval, all those processes. There are costs attached to each. So they all make up ordering costs. Why are we breaking down the cost in this order? In a question, they might not just put it as ordering costs. They can just mention transportation costs, this, that. So you should know that these are the makeup of ordering costs. These are the makeup of ordering costs. Now, another point is the communication cost of loading and offloading. The cost of loading. So ordering costs are costs incurred when placing an order up to the point of receiving the goods into the warehouse. That is ordering costs. That is ordering costs. So now, hope that is clear, please.
Yes, sir.
Yes, sir.
Yes, sir.
So now looking at carrying or stock holding costs. What can we say about that? Carrying or stock holding cost. Carrying or stock holding cost. Anybody to speak to that?
Okay, I think if I can remember vividly, the warehouse cost.
Cost of keeping a house.
Okay, yes, I think that is fine. So the carrying or stock holding costs. These are costs incurred whenever material is stored in the warehouse. You know, as you keep the stock in the warehouse, in some organization, they fumigate. They do certain things to prevent maybe reptiles to touch their products. So there are certain costs incurred to make sure that the goods are safe, the goods are in good condition, maybe refrigeration, things like that, the air conditioning, and the rest of it, all those costs. So carrying costs per unit, we must note, is directly related to purchase price per unit. And what are the components of this carrying or stock holding cost? Number one, we can have insurance.
So
You
sir,
need
can you
to.
come again with that the note? Carrying costs per unit
Okay,
is
I say carrying cost per unit is directly related to the purchase price per unit. We tend to see that when we calculate, trying to calculate each of the components, carrying costs per unit. The carrying costs per unit is directly related to the purchase price per unit of each of these products. So the carrying or stock holding cost, what are the components? What are the components? Insurance. You know, when you put your goods in the warehouse, it is a very good company. You have to insure those goods. You don't just leave it like that. In the case of fire, in the case of theft. So the cost of keeping those goods in good condition, insurance is one of it. Audit. Yes, in some organization, those stock in the warehouse, they do send auditors, either from the head office, to come and check. Unexpected visits by the auditors. You know, some organizations, the store officers, they do play some games with the stocks. So there can be an unexpected visit to the organization or to a branch of the organization, because some organizations have branches. Those involved in sales, services, they understand this. It can be an unexpected visit. So for immediate stock counts, and some situations whereby you've issued out stock, you gave out stock without following the right channel, without billing it from the system to reduce the stock in the system. And the value of stock in your system is different from the physical. The auditor will query that process. So I recall those days, once we are doing stock counts, we print out our stock from the system. We use Navision there. Then we make sure we tally it with what is in the warehouse. Both the branch manager, the accountant, and the warehouse manager will be in the warehouse. They will count to see that everything we have in the physical tallies with what we have in our system. So all this process, there are costs of carrying or holding the cost. Now, damages and privileges, damages. There can be damages in the warehouse. It's also a cost, a loss to the organization. Yes, most times we have what we call warehouse damage. Warehouse damage. So once you have warehouse damage, those days we bill it out from the system to reduce what we have in our system and to also eliminate it in the physical, remove it from the good stocks so that we have a balance. So those damages are also costs to the organization. And also those stock taking process too, they can be tasky where it is not done by us. And when somebody is sent from the head office to the branch, there can be issue of paying the person's DTA, that is the duty to allowance, the various allowances associated with the fellow coming. So those costs, and some organizations, they rent warehouse to keep those stock. Is also form part of the stock holding cost. The rentals, rent. That is why some organizations, they try to do away with warehousing, keeping stock. They push that burden to the distributors. So instead of them having a warehouse in each state of the country, they have big distributors whereby as they distribute from Lagos to various locations, let's assume the head office, the manufacturing plant is in Lagos, as they distribute to various states, they have distributors. Instead of them having their own branch in those states to store those things, no, they don't do that. They use the distributors to bear those costs. So you see some distributors have big warehouse. Yes. So they are doing that function, playing that function on behalf of the company itself. So the rental and spoilage, that is deterioration, all these costs you incur of keeping the goods, their carrying or stock holding cost. So stock out cost. What is stock out cost? Anybody to talk on that? Stock out cost.
The costs you incur for being out of stock or not having inventory to sell.
Yes, that is it. So these stock out costs, these are costs incurred when customers' demand cannot be met because the stock is exhausted. So there are the opportunity costs of not having a stock when there is effective demand. What is effective demand? This make me to recall something. Effective demand. What is effective demand? I believe we have those that studied economics here too. Effective demand.
I think we'll use the as the name implies, effective demand. It's the willingness of customers to purchase the stock or the inventory or the item in the stock.
Okay, okay, okay. Willingness. All right. Yes, the word is relevant, but you can be willing and not have the ability, the purchasing power.
Yes, the willingness and the ability, the purchasing power to.
Yes, yes. So that is the point I'm trying to drive at. That effective demand is you having the willingness and the ability. So where we have people willing to buy, their money is here, but we don't have the stock. The cost we bear is termed as stock out cost. And what are example of those costs? Loss of turnover, loss of sales, loss of goodwill, your reputation. Because I already have assurance that coming to you, I should get this stock. But I was here last week, same story. You're giving me a story that you don't have this product. This week I'm here again. You're telling me that you don't have the stock. It means I have to look elsewhere. It means even when a friend is trying to tell me, let's go to so place to get this stock, I'll say, no, don't go there. They might likely not have it. That is how you begin to lose sales because you fail to meet your customers' demand over time. And also, when there is stock out cost, another cost associated with it is that we can lose qualified staff. Somebody will ask, how does this relate to that? When you don't have stock to produce in your factory and your workers are idle, because maybe you are paying them per day, they will go and source for another point, another organization where work is going on, where work is moving because they need daily pay, they need weekly pay, they need monthly pay to cater for their basic need. And once you are always out of stock and they are idle, they can tend to source for another organization where they will earn their daily means of survival. So as you lose qualified staff, is a burden on you, is a cost on you. When there is need for you to produce and you can't get qualified staff to drive the, let me say, the fork fleet now. The fork fleet is a machine that lift items, yes, in most warehouse, move pallets in most warehouse. So when you don't have a personnel to help you operate that forklift, it can be a cost. It can be a cost on the organization because you've lost someone that can help in the production process. So organization, yes, Chidima. Okay, you lifted up your hand. So the stock out costs can also result into loss of trade secrets. When you lose a staff, to another organization, some of your secret, most likely it can be your competitor now. Some of your secrets in the organization can be revealed to your competitor, and they will use that over you in the business. So it's very good to try to guard against some of these things in organizations. So in order to have smooth run. So we have purchase cost. Who will speak to this? Purchase cost. What does purchase cost signify? Purchase cost.
Purchase cost.
Yes, ma'am.
I want to try. Okay, I want to try on this.
All right, ma'am.
It can be simply illustrated as total amount spent in acquired goods and services.
Okay. Yes. 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 So that is the actual cost of the items placed in stock. So okay, Chidema says she's speaking, but no one can hear. Yes, we're not able to hear you. You can put your write-up in the chat box. Yes. So purchase cost refers to the price. Purchase cost refers to the price paid per unit of an item or raw material when it is bought for inventory or for production purpose. So this purchase cost is a direct cost and is often the largest component of total inventory cost, especially when we are dealing in a manufacturing organization. So the purchase cost per unit is used in the determination of economic order quantity. It's used in the determination of economic order quantity. Just as you've said, it is the actual cost you use to incur those items that you need in an organization. So the key point we must note in purchase cost is that it is also called unit cost or acquisition cost. Yes, that is purchase cost. And in purchase cost is a direct cost. The direct cost traceable to the unit, to the production process. So it is void of indirect cost. It is void of indirect cost. So the cost of that particular item, that raw material you are incurring is a purchase cost. So this will now lead us to economic order quantity. Economic order quantity. This is not new, this is not strange. What is economic order quantity? Economic order quantity. What can we say about it? Economic order quantity. Economic order quantity. Anybody to try? Economic order quantity.
Okay, I think is an inventory control. Okay, I think it's to determine the minimum cost, inventory cost to incur, either the holding cost or the carrying cost.
Okay. Okay. Economic order quantity.
I think the ideal order quantity that will minimize inventory cost, and I think that is what I can remember.
It's fine. Yes, that is it. That is it. You're very correct. Economic order quantity. Anytime we are talking about the word economy is in an item, it shows that being rational trying to minimize cost. So economic order quantity, that this is the level at which the cost of inventory control is at minimum. What are those costs of inventory? Holding costs, ordering costs is at what? Minimum. Is at minimum. Get this understanding. The economic order quantity is the level of activity at which the cost of inventory control is at minimum. And what are those costs of inventory control? Can I get response? What are those costs of inventory control?
Holding costs, carrying costs,
Fine. Holding costs, carrying costs. Yeah.
ordering costs.
Yes. So it is the quantity of stock which is normally ordered each time the stock is being replenished. So economic order quantity is an equation for inventory that determines the ideal order quantity a company should purchase for its inventory, given a set of cost of production, demand rates, and other variables. This is done to minimize variable inventory cost. So I'll say that economic order quantity is the ideal order quantity a business should purchase to minimize the total cost of inventory. The total cost of inventory is your ordering cost plus your holdings cost. Take note of that. Take note of that. I think I'm thinking of a question that involves some of these bringing these things together so that we understand ordering cost and holding cost. So there are certain assumptions that we have to know when treating questions on economic order quantity. The assumption is this, that is put down, that we have to know that purchase price is known and constant. So when you're solving questions on EOQ, the purchase price will be known and it is assumed to be constant over time, does not change. That is an assumption that you have to work with. You have to work with when you're solving questions on EOQ. And annual demand is known and constant. Take note, annual demand, because in a question they can give you monthly demand. So if your monthly demand is 1,000 units, your annual demand will be what?
Times 12.
Fine. Times 12. Times 12. Take notes, because they might not give you annual demand as a whole figure. They can just tell you that the monthly demand of company XYZ is 500 units. So you will now be left. They will not tell you that you should multiply it by 12. You should know. Yes, you should know. Yes, you shouldn't start looking for 12 in the question. So note this assumption now, that where you are not giving the annual demand as a whole figure, and you are either giving annual demand or giving demand in weeks, you should ask yourself, how many weeks do we have in a year? You should know that mathematics. Yes, how many weeks make up a year? You should know. So how many weeks make up a year? Let's ask ourselves now.
Is it not
I think it's 52 weeks.
52.
Fine, 52. 52. So the examiner will not tell you. The examiner will not tell you. So we should know. We should know that it's 52. So when it comes to most of these questions, you're expected to use certain knowledge based on this assumption, because sometimes you might not remember that there is one assumption. You just be wondering that where is this figure coming from? Where is 12 coming from? Where is 52 coming from? You should remember this assumption, that annual demand is said to be known and constant, does not fluctuate. So ordering cost is known likewise and constant, does not change. That even when the level of activity changes. What do I mean by level of activity? Level of units demand. Maybe you have 400 units, 500 units, 600 units, 700 units, 800 units. At each of those activities, the ordering cost is said to be known and will be constant. It does not change. And also carrying cost is known and constant. Then replenishment is instantaneous. That is, it can happen instant, it can happen unexpected. You can decide to replenish without any notice. So depending on your policy as an organization. So take note of these assumptions. Determination of economic order quantity. It can be, you can determine the economic order quantity using two approaches. That is using the algebraic method or using the graphical method. Right? The focus of the syllabus will be on this algebraic method. Yes. So the algebraic method is not something too ambiguous. It's not something that you cannot surmount. It's something simple, as I always say. Yes, it's simple. So for you to solve questions using the algebraic method, see this formula here. You can write it in your book. EOQ, economic order quantity. For you to get it, is the root. This is root. You can write it big. This root sign, and everything is inside it. I was looking for an appropriate parameter root to use, but I could not. I don't have the patience to look for it, so I just used this one like this and have my division as slant. So when you're writing it in your book, you draw the roots big, and in the roots, you're expected to determine the root of what? 2 multiplied by D multiplied by CO divide by CC. What is the interpretation of all this? D, 2 is always constant, given in the, must always be in your formula. Yes, this is the formula in simple terms. So what is D? We said D is the annual demand. Annual demand. So when you are given a question that you have to purchase, an organization purchase these or demand these in months, quickly convert that monthly demand to annual. Yes. So D is annual demand and CO is ordering cost. In some questions, you see it as ordering cost. In some questions, they can put it as cost per order. That is why I put it slash. So that when you are seeing cost per order and you are not seeing ordering cost, don't say, but they didn't tell us the other name for ordering cost is cost per order. Just know it, interpret it, ordering cost, costs per order. How much are you incurring when ordering? Yes, so take notes, costs per order, ordering cost, them in a question. That's, you substitute these into this formula. Then we have CC. If you look at some reading tests, they can change this right up. You can express ordering costs using an alphabet that suits you, but just know that the numerator will consist of what? Your annual demand, your ordering cost, and the denominator will be what? Your carrying cost or cost of holding. Cost of holding 1 unit for 1 year. Cost of holding 1 unit for 1 year. So this is the formula that EOQ is equal to the root of 2DC 0 divided by CC divided by CC. So now let me add something to this. Let me add something to this formula so that I just want to interpret something in relation to this formula. But this is the main formula, please. Just take note. I just want to add something to it. for example, a question is asking you to get the total cost, or the total annual relevant cost. Maybe there can be a question in that form. Let's say total annual relevant costs. Total annual relevant costs. Now, what will be your total cost component? Your total cost components. I've asked this question before now. It will be your total annual what? Total annual holding cost. Holding cost plus, let me say, total annual ordering costs. Total annual ordering costs. Reduce this. Total annual ordering cost. Because I'm thinking of a question in this direction, I can decide to send it as an assignment. I recall I forwarded an assignment. I don't want to talk about that. I recall I forwarded an assignment earlier today. That is not part of what we are discussing. It's what we've discussed before. So I want you to see yourself in an exam situation that, why is this thing confronting me? Now that you are seeing it. So to get the total annual holding costs, what do we need to do? The formula can be this way. We can simplify it this way again. We can simplify it this way. Let me see. Okay. Let me just say number of order or number of reorder. Let me place it that way. Number of reorder. Divide by 2. Let me use my light to be well. So we can have it in this way. To simplify the above, can be in this form. Let's say number of reorder divided by 2. Number of reorder divided by 2 multiply by carrying cost. Please, in your book, write carrying cost, but I want to represent it as CC. But in your own book, write it as carrying cost, so that I'm telling you to write it as carrying cost so that you not ask me later, what is CC? Plus, it can be plus, that is total annual ordering costs. That is, this annual ordering cost can be number of order. Multiply by what? Multiply by cost per order. So, what I've expressed here is a summary. In a question, you might be given each of these. So you should know that to get your total annual holding cost will be what? It will be number of I think Chidinma's audio is bad, so anytime I'm trying to speak and You can put your question in the chat box, please, in case you have any concern. Just put your question in the chat box. Your audio is so to get your total annual holding costs, your number of order divided by 2 multiplied by carrying costs, you get this. This is a summary. In a question, you will not be giving this as a whole, as a lump sum. You need to check what is the makeup of this. You need to check what is the makeup of this total annual ordering cost, number of order multiplied by cost per order. So there might be questions in that light. Yes, in that direction. That is why I'm bringing forth this. But most times what we know is this economic order quantity. What we know is this. So, but I'm trying to take it further, that you can be asked to determine total annual relevant cost and what are the components, which is this. Yes, this is ICANN. Anything that we need to tell you, I must say it so that you will not see anything as a surprise in the whole. Yes, and that is why I have to say anything and present questions to you. Like that question I forwarded in earlier today is an ICANN question. Yes, an ICANN question I forwarded so that you can see how to treat question and working capital management in another way. Yes. So, and I have quite a number of them, which I will be dishing out one after the other. Yes. So I want us to look at this example. Then I will give my own class exercise. Yes. Let's look at this example. Can somebody read? Though I've solved it in my slide because I use this slide for my YouTube presentation, which I forwarded to the platform. But we'll see the explanation anyway. We'll tend to solve it again. Yes. Can somebody read?
Okay. A company requires 1,000 units of material X per month. The cost per order is $30 regardless of the size of the orders. The holding costs are $2.88 per unit. Required. Investigate the total cost of buying the materials in quantities of 400, 500, or 600 units at one time. What is the cheapest option? Use the EOQ formula to prove your answer is correct.
Yes, thank you very much. So that let's analyze the question before trying to solve it out. That a company requires 1,000 units of material X per month. So in a year, what will be the total material to be required in a year?
12,000.
Fine, 12,000. 12,000. I hope nobody will ask me how we get 12,000, right? We've explained that before now. This when I was explaining those assumptions, right? That demand will always be assumed to be constant. So in a month, if you should obtain 1,000 in a year, the demand will be what? 1,000 times 12. You have 12,000. 12,000. Another question I want to ask is this. The question says that investigate the total cost of buying the material in quantities of 400, 500, and 600. Now, what will be the average inventory of 400, of 500, of 600? What will be the average? The average inventory. Average is something divided by 2, right? The average of 400 will be what? Not the average of the monthly demand now. The average of the quantities.
That will be 750.
Yes, the average of 400 will be 200.
Mhm.
The average of 500 will be what? 250. The average of 600 will be what? 300.
300.
Madam Roots, are you in hostel?
I'm sorry, sir.
Then, now the question again is this: what will be the number of orders per annum if, let's say, in a month, investigate the total cost of buying the material in quantities of 400, 500, or 600 units at one time? It means in a month, let's assume in a month, we are buying 400 units, and the total demand for that year is 12,000 units. If we should demand 400 units per time at one time, how many times are we going to place order in that year? Can somebody try? Per order, we are making a request of 400 units. 400 units. Anytime we want to place order. So what will be the total order, the number of orders we experience in a year? You must be able to interpret this.
That's 100 multiplied by 12.
That is, okay, Noble, 400 by 12. Kimi Godfrey, 30. Yes, I think Kimi Godfrey is there. It's 30. You know, annually, I said you are able to, your total demand will be 12 times 1,000. You have 12,000 units. Now, you are now demanding 400 units anytime you want to place order. How many order can come out of 12,000 units when you are demanding 400 units? It will be 12,000 divided by 400 units. You have the number of order per annum. Can you punch your calculator to get that? 12,000 divided by 400 will give us what? Will give you the number of orders per annum. Per annum.
That's 30.
30. Yes. You look at the English. Unit is different from order. The unit you are demanding when you place one order make up of how many units? 400 units. That is an instance. When we start treating activity-based costing, we'll start talking about similar thing again, talking about batch, order per batch. So now, one order make up 400 units. So how many order can we derive if we are placing 400 units per order from 12,000 units per annum? It will be 12,000 units divided by 400 units. You have 30. If the order is 500 units, what will be the number of orders per annum? If the order is 500 units, what will be the number of orders per annum? 24. Yes, I can see it. 24. Yes. Now, if the units per order, 600 units, what will be the number of order per annum?
20.
It will be 20. Fine. It will be 20.
Yeah.
20. 20. It will be 20. It will be 20. It will be 20, yes. Yes. It will be 20. I showed a formula just now. Let me go back there. Do you see this? Do you see this formula? Number of reorder or number of order divided by 2 is signifying that what? The average, isn't it? Average. Signifying what? Average. Isn't it?
24.
Yes. So I'm just trying to explain this. That number of order divided by 2 is telling you what? Average. 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 So now let's move further. Let's move further. Now, what will be the holding cost? How do you determine holding cost? How do you determine holding cost in this scenario now? How do you determine holding cost? Anybody to try? I'm coming back here to give you a clue now. How do you determine holding cost? Yes, can you give a trial? Holding cost. See, total annual holding cost. The breakdown is this. Number of reorder divided by 2, which will give you average. Average multiplied by what? Carrying costs. So now, in this question now, the carrying cost is what? Or the holding cost is what? 2.88 per unit per annum. 2.88 per unit per annum. So for you to know the holding costs, the total holding cost, it will be your average unit multiplied by what? Holding cost. That is why I was showing you this formula, average here, average multiplied by carrying cost, which is otherwise known as holding cost, will give you your total annual holding cost. That is why I was coming back there to give us the clue. So now, to get the holding cost, it will be your average unit, that is for this, let me see, 200 multiplied by 2.88, which will give you your holding cost, your total holding cost. Yes. Please get that. It will give you your total holding cost. So for 400 units, the average inventory is what? 200. 200 multiplied by 2.88 will give you 576. I just punched that in my calculator. So your total holding cost is average unit multiplied by what? By the holding cost per unit. See it, per unit, per annum. So the total holding cost per annum will be 2.88 multiplied by the average. That is why I showed this formula here, a breakdown of it, so that when you are given a question, you follow it in that order, where you are not giving those variables as a whole. They are not telling you the demand is this is that, and you need to solve on your own. Now, required, okay. The other part is ordering costs. Ordering costs. The ordering cost, this is it. Number of order multiplied by cost per order. So in relation to this question now, for under 400 units, the ordering cost per unit is what? The cost per order is what? $30. Cost per order is
$30.
$30. Fine. Now, under 400 units, how many orders do we have? How many orders do we have?
30.
30. Fine. So, for you to get the ordering cost, the total ordering cost, it will be what? Number of orders multiplied by what? Cost per order. See it. Number of order multiplied by cost per order. So it will be 30 multiplied by 30. You have what? You have 900. You have 900. So when you add your holding cost and your ordering cost together, you have your total cost. You have your total cost, which is this. See it here. Total annual relevant cost. This is it.
Wait, sorry, Mr. Can you come again? That 30. I'm looking at where you got. I
All right.
kind of left class for a while.
Okay, yes.
So I need that. Yeah.
Yes, the 30, the total.
Likewise, me too.
No problem. No, I will show you the workings. I just want us to get the analysis before going to the workings. Yes. Everything
All right.
is detailed in the workings, but I just want us to get an overview of it. Yes. So the 30,000 number of orders per annum, the total units per annum is what? 1,000 times 12, right? Which is 12,000 units. 12,000 units. Now, how many order will you get if you are requesting for 400 units in one order? How many order will you get if you are requesting 400 units in one order per annum? It will be 12,000 units divided by 400 units. You have what? 30 orders. 30 orders. Now, this order 30, holding cost per order is what here? 30. So to get your total ordering cost, it will be what? It will be what? Number of order multiplied by cost per order. Isn't it?
Yes, sir.
So it will now be 30 multiplied by 30. You have 900. See it here. All what I was trying to talk about. We have three case scenario: 400 units, 500 units, 600 units. For you to get your number of or for you to get your holding cost, you must know the average unit. The average of 400 is what? 200. The average of 500 is what? 250. The average of 600 is what? 300. How many orders do we have per annum when we have to request for 400 units? It is what? It is 12,000 units
12,000.
divided by what? 400. You have 30. You have 30. Okay, I've even showed it here. Yes, you have 30. You have 30. So now your holding cost. How do you determine holding cost? This is it here. Average of your unit or your order multiplied by costs, carrying cost or your holding cost. Which is it here? Holding cost is average units. When you are giving total units, you divide it by 2 to get your average. Multiply by what? The holding cost per unit, which is given in the question. This is it, holding cost per unit. So the total holding cost will be what? Will be 576. That is 200 multiplied by 2.88. Punch your calculator to see that. Will be 576. Will be 576. Are you there?
Yes, sir. It's fine, sir.
Yes, sir.
It's okay.
All right.
Thank you.
For 500 units, the average 250, number of orders, it's 24. How do you get that? When you say 12,000 divided by 500 units, you have 24. Now, the holding cost will be what? The average is 250 multiplied by what? Holding cost per unit, 2.88. 250 multiplied by 2.88, you have what?
720. 720.
So same applies to 600 units. That is, the average is 300 multiplied by 2.88. You have 864.
864.
Now, the ordering cost, number of orders per annum for 400 units is what? It's 30. Isn't it 30? So, number of ordering costs, number of orders multiplied by the cost per order. This is it. Cost per order, which is 30. When you multiply 30 by 30, under 400 units, you have what? 900. Isn't it?
So you're correct.
So now, under 500 units, the number of orders we have
24.
24. 24 multiplied by 30, you have what?
720.
20.
Fine. Under 600 units, the number of orders is what? 20.
20.
20 multiplied by 30 is what?
600.
600.
Fine. Now, the total cost will now be what? Holding cost plus ordering cost will give you total cost.
Yes.
76 plus 900 will give you what? 1476. 1476. 720 plus 720 will give you what?
1440.
Yes, 1440. And for 600 units, 864 plus 600 will give you,
1464.
yes. Somebody will ask, why are we having 720 as the total holding cost and 720 as the total holding cost? Who can respond to this? Based on the definition of EOQ. Based on the
Come
definition.
again, sir.
Now, if you look at this solution, you are seeing 720 here, holding costs under 500 units, 720
Yes,
ordering costs under 500 units. Why? Why are we having this? What is the interpretation of this? What is the interpretation of this? From our definition of EOQ.
Okay, can I try?
Yes, very well, ma.
Okay, I think this is the point where I think that's the minimum cost. I'm trying to put my words together.
That's the optimum cost where holding cost equals to ordering cost.
Okay, fine. Now let's now look at the total cost. Compare the total cost. Which is the least here?
At 500 units.
Fine, at 500 units. So which meaning can you infer? Can you draw up from this again? What can you draw up?
500 units is the more efficient quantity to order, because if at that point I will have the least cost.
That's the level
So-
at which the inventory cost at.
I think that's the minimal. That is the ideal order quantity that minimize the total inventory cost.
Yes. Though the answer is on the screen, but I just want us to, yes, instead of cramming, and let's be able to make meaning out of what we are solving. It will help us better. Yes, everybody is correct. We are fine. We are correct. So let me just give a summary of what we've said. Yes, that the point at which holding costs and ordering costs are equal is called economic order quantity. So economic order quantity is the order quantity that minimizes total cost of inventory, minimizes the list now, minimizes total cost of inventory. And the total cost of inventory includes the ordering cost, that is cost incurred every time an order is placed, and the holding cost. These are the combination of these two gives you the total cost. The holding cost is the cost of storing of unsold goods, which we've explained. So now, this point now, when you solve and you see that these 2 points are equal, it will definitely also give you the least total cost. It means it's better for you to buy 500 units because you have a least total cost, because you're trying to minimize your cost. That is the concept. If it is profit, you maximize. So this is the economic order quantity. I put a point here that the best option is to order 500 units each time. Why? Because this is the point at which total cost is minimized and the holding cost and ordering costs and other costs are equal. I think it can still go that way. And other costs are equal. So now, all these things, we can prove our answer through the formula. You know, we broke down the formula using this table. Instead of using this table, we can apply an easy approach. Now, you substitute into this formula the roots 2 multiplied by demand. Annual demand is what? 12. 2 times 12, right? Isn't it?
Yes, sir.
2 times 12,000. 2 times 12,000 multiplied by what? Multiplied by what? By
Carrying
what?
cost.
ordering costs.
So the value is, yes, the value is what? The value is 30, right?
Yes.
So 2 times 12,000 multiplied by 30 divided by what? Holding cost, which is 2.88, right? Which is 2.88, right? So
Yes, sir.
when you solve, what will be your results? What will be your results? Solve it.
500.
Fine,
500
500 units.
units.
Yes, 500 units. So what we've done is to explain economic order quantity using this and with a check using this formula, because the question makes it clear that investigate the total cost of buying the material in quantities of 400, 500, or 600 units at one time. What is the cheapest option? The cheapest option. That is why we're going for the least cost there. Use the EOQ formula to prove your answer is correct. Anybody find it difficult to get this? Maybe you are not punching your calculator right. You know, you can speak up. We can help you out. Yes, because sometimes, you know, when it is over time, you've punched your calculator, you might forgot how to do some things, and it might look as if you are trying to climb Mount Kilimanjaro because of yes. Hope everybody is fine at this point. Are we clear? Can I get a response? Okay, fine. Okay.
Yes, sir.
So please know this thing. Know it. Know it. It is examinable. Know it. I'll forward the question to test our understanding again on this. Though I put some of this note here, though it's not in the syllabus, but I discovered that it's something that is supposed to be part of it, and that is why I included it in my slide. Inventory level, there are some things that you know that inventory level refers to the different level of stock which are required for an efficient and effective control of materials and to avoid over and understocking of materials. The purpose of material control is to maintain the inventory raw material as low as possible, and at the same time, they may be available as and when required. To avoid over and understocking, the storekeeper must fix the inventory level as at when due. So I put forth that the following are the various levels of inventory. We have maximum stock level, minimum stock level, reorder level, average stock level, inventory turnover level. When we talk about the maximum stock level, what are we referring to? It is the maximum that you cannot go beyond. You can put your comments. We can't hear you, and your audio is making us scary somehow. The maximum stock level is the level above which stock should not normally be allowed to go beyond. That is the maximum stock level. At least in your organization, even when you are trying to keep stocks, you should have a maximum point, a ceiling point that you shouldn't go beyond. Based on your trend analysis of stock management, at least if you are to keep stock, you can decide that we shouldn't keep stock beyond 12,000 kg in our warehouse. Yes, and the minimum stock level too is the minimum you should not go beyond. This is the level below which stock should not be allowed to fall. That is the minimum stock level. Once you are getting to that point, there should be reordering. Once you are getting to that point, there should be reordering. And reorder level, this is the point at which it is essential to initiate purchase requisitions. You initiate requisition, which will pass through various stages. Yes, because you've already seen that there is a need for us to have our warehouse refilled with stock. So once you are getting to that line, to that point, yes, you initiate requisition for stock to be obtained. Also, we have the average stock level. The average stock level, this shows the average stock held by a firm. How do you get the average? It is your maximum plus minimum divided by 2. Yes, average plus minimum divided by 2. Then we have our inventory turnover level. The inventory turnover level is what? Is a ratio showing how many times a company inventory is sold and replaced over a period of time. And then we can have a formula in relation to that. Don't worry, I have everything in the slide. I will forward the slide to us. The stock turnover level will be the material consumed during the period divided by average stock level. That's will be the stock turnover level. So I would just want us to talk about just in time. It's also a method of controlling stock. Just in time. What is just in time? those of you that have studied this, just in time is in PM is related to throughput accounting. Yes, throughput accounting. So when we talk about just in time, what are we talking about?
There's no inventory. Once they buy, they don't buy to keep, they just buy to satisfy their immediate customer needs.
Yes, and it's just in time. Just in time is a system whereby keeping of stock is avoided to the barest minimum. As we require stock, we place order for it. So this just in time is an inventory management and production strategy where materials, components, and products are received or produced only when needed, rather than being stocked in advance. Is a method of inventory management, is a technique of inventory management likewise. So the just-in-time procurement and stockless productions are terms which describe a policy of obtaining goods from suppliers at the latest possible time, that is, when they are needed. And so avoiding the need to carry any materials or component stock. Now, what are the benefits of introducing just in time? What are the benefits of introducing just in time? The benefits of
It
introducing.
reduces costs.
Okay.
Reduces holding costs, warehouse costs.
Yes. Reduction in stock holding costs. It reduces manufacturing lead times and improved labor productivity. And we can say sorry, you're asking a question.
I say, how does it improve labor productivity?
Okay. The just in time, it helps to improve labor productivity because when you have a need to produce, you make sure that as you make your demand in terms of the raw material based on what you need, you make sure you don't cause any wastage. You work effectively and efficiently, because by the time there is wastage, you don't have anyone in the warehouse. You start calling again.
Order.
Yes, when you have a backup somewhere, you can be reckless. Yes. So it helps to improve labor productivity because the outputs you produce per unit will be related to the labor input. So it will make your workers to be efficient in the use of the raw materials they use to produce goods and services. So instead of having too many raw materials that will result into wastage, what you have, the production manager, will make sure that you monitor those workers for there not to be any form of wastage and the right quantity is used in the right proportion. So it will help to improve productivity in that line. That is just in time for you. That is just in time. But in the notes, let me see what I put down in the notes. That's objective of just in time: to ensure smooth flow of work through manufacturing plants, to ensure flexible production processes, which is responsive to the customer's requirements, and to reduce capital tied up in inventory. These are some of the objectives. Because when you keep keeping stock in the warehouse, you're tying down your capital. Yes. But it has its demerits because sometimes you might not be able to meet customers' demand because you don't have stocks in the warehouse. And where there are scarcity, it means you close down production for those periods. So those are some of the demerits. But where this system work in developed countries, like I think this concept was put forth by Kaizen. It has been tested in Japan over time, even with the concept of the throughput accounting. Yes, when we're talking about that in PM, in some developed countries, they don't pile up stock. Where things work effectively and efficiently, just a call, just a mail, your goods are delivered, you produce, you send to the end user. In such organization, in such developed world, but where we are still trying to come up, when you try that in our country, it might not work because you can be held up in traffic. For some of you that stays in where traffic is the order of the day, you know such things might not work because some people can stay in traffic for hours. So just in time is a very good approach to production where the factors of productions are working optimally. So the essence of this is to reduce stock levels, which means that a lower level of investment in working capital will be required. So just in time will not be appropriate in some cases. For example, let me say a restaurant now might find it preferable to use the traditional economic order quantity approach for staple non-perishable foodstuffs, but adopt just in time for perishable, isn't it? Yes. And they can adopt just in time for exotic items likewise. Let's talk about in a hospital, a stock out could quite literally be fatal where you don't have drugs in the hospital. So just in time will be quite unsuitable in an hospital because there should be drugs. You cannot predict what you diagnose a patient with at a particular point in time. So you should have varieties of drugs at your pharmacy. So the system of these just in time in procurement depends. So I'm just trying to, I thought you want to speak. So just in time, the aim of just in time is to improve production systems by eliminating waste and avoiding production bottlenecks. There are so many concepts related to this. We can also have a concept of TQM. There's what we call total quality management, but it's not part of the syllabus here. Total quality management. What does this entail? This total quality management is a management technique derived from the Japanese companies, which focus on the belief that total quality is essential to survival in a global market. The basic concept or principle of TQM is that cost of preventing mistake is less than the cost of correcting them once they occur. Yes, the cost of preventing the mistake is less than the cost of correcting them. So it's better you prevent a mistake than you allow it to occur because you incur more when you allow it to occur. So this also is a concept in the palace of stock management, but it's not part of what we are asked to look at. We are just asked to look at EOQ and just-in-time techniques. And still under working capital, we are asked to look at account receivables. Under account receivable, we are asked to talk about assessing credit worthiness, collecting amounts owing, offering early settlement discounts, using factoring and invoicing discounts. Then we are asked to discuss the concept of payable, which is also under working capital. There is current liability now, the concept of payable. So once we can discuss all this now, we'll be through with the part 2 of working capital. So we'll continue on receivables tomorrow. We'll continue on receivables tomorrow, because then we'll move to reasons for holding cash. Let me even ask, what are the reasons for holding cash? We talked about this in economics, in our normal secondary school economics. What are the various reasons for holding cash?
Emergency purpose.
Okay.
Daily operations.
Okay. I want you to speak as an economist. Use those economist terms they use.
For speculative purpose.
Yes, speculative purpose.
Transactional purposes.
Yes, transactional purpose. And there is one more.
Precautionary.
Precautionary purpose. Yes. So it's the part F that explain the various reasons for holding cash. Apply the use of relevant techniques in managing cash shortages, treasury management, and cash control, such as Baumel model and the Miller assessment. So is what they want us to discuss. And after that, calculate the level of working capital investment in current asset and discuss the key factors of determining this level, the length of working capital cycle, terms of trade, and organization policy on the level of investment in current assets, the industry in which the organization operates. Once we can discuss this, then we are fine with working capital. Then we'll move to investment appraisal, where we'll talk about payback period, accounting rate of return, net present value, and internal rate of return. So we'll keep moving. Yes. So thank you very much. And I'll send an assignment regarding EOQ, expecting everyone to solve and submit.